Welcome back, everyone. This is Thomas Triple T Ty with another nooblish educational video on crypto. Before we dig in, if this video adds value for you, feel free to smash the like, ring my bell, hit subscribe, or leave a comment anytime during this video. Appreciate your time. Let's dig in and take a look. We're going to be talking about what is position sizing, and it has a lot to do with risk management. So what is risk management? In finance, risk management is the process of identifying, analyzing, accepting, or hedging against uncertainty. In layman's terms, it's reducing potential loss while maximizing returns so you can stay in the game longer. And we all want to stay in the game longer. Without risk management, a winning strategy can still lose. So even if you have a really good strategy, if you're not managing your risk, eventually you lose. Let's take a look at an example. We have Bob and Tina. Both have $100,000 in their trading accounts. They both have a winning rate of 50%, which means that, let's say 10 out of 10 times, they win 5 times and they lose 5 times. And the reward and risk ratio is 2 to 1. I'll go into that in a separate video, but I also have tweet threads about it. So I'll give you links to those. So let's assume they make 10 trades, and this is what's going to happen. So let's assume they're going to make 10 trades, and of those 10 trades, they both went loss. First 5 are losses, and next 5 are wins. So that's 50% on a winning record. So let's take a look at Bob first. Let me get my highlighter on. There we go. So let's go with Bob. On his first trade, again, remember, we're going to go lose. So Bob, he's aggressive. He's like, I'm the man. I'm going to go hard or go home. So he out of his $100,000, his first trade, he loses $20,000. Next trade, again, is a loss. So he loses $20,000 more. And so on and so forth until the 5th trade. He loses $20,000. So within 5 trades, this aggressive investor, loses his entire account of $100,000. That's negative 100%. And his balance is 0. Tina, on the other hand, she's a little bit more conservative, and she doesn't mind, making a little bet here and there. So she trades less. So Tina, on her first trade, she loses $2,000, and so she loses the same amount, let's say for 5 trades. So now she has lost $10,000, but she's still in the game. Remember, she has $100,000. So here she lost $10,000. She's down to 90, right? But in the next 5 trades, as we already set up, she wins 5 times in a row. So she wins 4,000 here, and then 4,000, and so on and so forth until the 10th trade. So here, she won $20,000 on the last 5 trade, but lost $10,000 in the first 5 trades. She nets $10,000. So her balance now is $110,000, or she gained 10%. So, okay, so that's good. What does that have to do with position sizing? Well, what we just went through, that's position sizing. Position sizing is how many units of a security or asset an investor can make within their account to minimize risk and maximize return. What does that mean? Let's put some numbers to it. It's recommended that you risk no more than 1% of your total account balance in per trade. So what does that mean? They each have $100,000. So 1% of that would be $1,000. So for a trade with $100,000, for each trade, you should not be willing to risk more than $1,000. How do we calculate position size for crypto? Position size is account risk divided by trade risk. We already know that we are not willing to lose more than 1% of our total account balance, which is $1,000. So now we have the number for account risk. But what about trade risk? What is trade risk? Trade risk is the amount of money you're willing to lose for a single trade. Okay? Let's do an example to make it easier to understand. Let's say you want to buy BTC, Bitcoin, and the going price is around $44,000 right now. You want to buy Bitcoin at $44K. You have a balance in your account of $100,000. You don't want to. You think the price could go down like significantly, so you want to put it in a stop loss at $42K. What a stop loss is, if the price crashes really fast, and you buy it at 44K, you don't want to be underwater too much. So you want to set a stop loss so that it would sell at 42K. That means you will only lose $2,000 here. Okay? So trade risk is equal to the entry price you want to buy at 44K minus the stop loss, which is 2K. So our trade risk is 2,000. So let's go back and calculate the position size for our example to buy BTC. How much BTC can we buy? So our account size is $100,000. Our position size is equal to account risk divided by trade risk. Our account risk is $1,000. Okay, that's the most we're willing to risk, is $1,000 per trade. Our trade risk, we already calculated, is $2,000. We're buying Bitcoin at 44, and we set a stop loss at 42. That's our trade risk is $2,000. So position size is account risk, which is $1,000, divided by trade risk, which is $2,000. So what is the 1% amount of our portfolio of $100,000 can we spend, and how much would that offer buy us? So based on the position size, we should only buy half a Bitcoin, which is spending $22,000. Okay, so half a Bitcoin, not a whole Bitcoin, only half a Bitcoin, with all these in place. So in summary, risk management helps you reduce potential losses while maximizing return so you can stay in the game longer. Position sizing is a method to help you manage your risk. The end. If you found this video helpful, feel free to smash the like, ring my bell, hit subscribe, and leave a comment in my YouTube comment section. Appreciate it. I'll see you in the next video, probably later on today. If not, more likely, and for sure, actually, tomorrow. Peace.